torn here. I hate to look at my 401k growth funds and I want to go to cash. um, that's not funny, unfortunately, but this is often something we get asked on a very regular basis. And the question is there a way to invest that does not, or that does well with inflation and higher interest rates? What we're seeing many times is an example of what happens in an environment where people had earmarked money to go into bonds and fixed income type assets that are unfortunately suppressed in value, just like the stock market is. And so by definition, that's really the opposite in most cases of what we're trying to accomplish. If we earmark money to go into a fixed interest or a safer type investment by definition. And so it's tough to look at your 401k balances and see if you're using balanced funds or target related funds that have bonds in them, because the idea by default is to have money in something that is offsetting the risk that you're taking with the funds that you have in the stock market. And so because of that, the growth funds obviously are great when the stock market's going up, but when the market is poor and the change for the inflationary environment, which erodes our spending capabilities going forward, and all of a sudden you see these growth stocks pulling back their estimates, which all drive stock prices down on the growth side, going to cash is probably not the most ideal thing to do in most cases. And so, because for the same reason we want to try to allocate our funds to offset the risk you're comfortable with, if you feel that this is important for you to do today because of the suppressed value of your 401k, I would argue that your 401k is far too aggressively invested for your liking. And so the primary goal for this particular scenario would be to go back to the drawing board and let's define what risk that you are willing to accept and be comfortable with, so that we can build a portfolio that's consistent with that and get that going as your core base. Because if you feel the need to react to a short window of time, like 6 to 8 months of negative performance in the stock market, and that's going to change your investment philosophy all of a sudden, I think oftentimes it just simply means that we needed to do some more homework ahead of time to figure out where your investment should technically go. Because going cash, although each and every situation is obviously different, what you're trying to do is effectively time the downside and the upside of when the markets happen. And most anyone that you'll speak to, including me or anybody at the firm, will not know the specific time of when the technical bottom and top of the markets are. And so you're never going to beat the markets like that over your life expectancy or over your retirement years. And so the better thing to do is to have a plan in place that's consistent with all the things that we've talked about in the past, being correlated to you and your specific goals and objectives, et cetera. So hopefully that helped.